Have you ever checked your phone or seen a headline about the markets crashing and thought, great, now what? You're working hard to retire early and escape the financial system, but it seems like every other month there's another crisis that threatens your ability to retire at all, let alone early. Well, in this video, you'll learn a single rule-based investing strategy that can keep you on path to your retirement and protect you from the next market crash. This is Jay. He's a friend and colleague that wants to retire early and find some kind of financial freedom. And he's doing everything right. He's maxing his 401k, saving aggressively, paying down debts, hoping he can find some financial independence and retire on his own terms. But as his savings grow, so does his fear of the next market crash and what that could mean for his retirement goals. He's scared that the next market crash is going to wipe out his savings and make him work for years or decades longer than he wants to. So Jay comes to me one day and says, I'm doing everything I'm supposed to. So why am I getting more and more nervous and more anxious? How can I make sure I'm able to retire before I'm 50? What is it that you're doing that's working so well? In this video, not only am I going to tell you what I told Jay, but you're going to learn the simple, single rule-based strategy that I gave Jay to help him not only shield his investments during market crashes, but helped him accelerate his path to financial independence. You'll learn how Jay went from feeling like he was in a car that was spinning out of control to feeling like he was sitting on a train, confidently riding it through the twists and turns of the market on its way to its inevitable conclusion of retirement on his own terms. So let's get started with the 200-day moving average. Let's go. If you want to see some data on this strategy, check the link in the description below. I put a 25-year back test. It's got all the performance results and data so you can check this out yourself. Why do you need this strategy? Why is it so important? To get started, the most important lesson of investing, whether it's stocks, bonds, real estate, it doesn't really matter, is risk management. You have to learn how to protect your capital and keep yourself in the game when things go sideways or crash. In other words, if you want to beat the market, you have to learn how the market thinks. And the market is obsessed with risk. So you need to be too. The 200-day strategy is a perfect strategy for that because it's based solely around risk management. So why exactly is risk management so important? Let's take an example portfolio. Let's say you have $10,000 in your retirement account and the market drops by 50%. Now your portfolio is worth $5,000. How much does your portfolio have to go back up by to get back to break even? Not 50%, 100%. Even though the market fell by 50%, you have to make 100% on the way back up just to get back to break even. Here's the thing about the 200-day strategy. Not only does it protect you from those 50% drops, but it helps get you back in on the other side when the market starts going in the right direction. So you're not getting back to break even, you're getting ahead. On the screen here, we have the chart for the S&P 500. The ticker symbol here is SPX. I'm looking in TradingView. And let's assume for the purpose of this video that we're working in a tax-advantaged retirement. Something like your 401k or Roth IRA, something like that. So we don't have to worry about taxes. We can just talk about the concept here. The gold line on the chart, that's the 200-day moving average. This is what we're concerned with. The 200-day moving average is the average closing price of the S&P 500 over the last 200 trading days. Not calendar days, trading days. There's about 250 trading days in a year. So the 200-day moving average is about 9 to 10 months worth of data. Now on my chart here, the blue bars are up days. These are days when the market goes up. These are days when the market closes at a higher price than the day before. The white bars are down, days where the market closed at a lower price than the day before. Okay, the 200-day average is the gold line here. And this is what we're going to use to determine the general direction of the market. In other words, the market trend. What we want to do is when the trend of the market is up, we want to be involved. And when the trend of the market is down, we want to go to cash and sit on the sidelines. And that's exactly what the strategy does for us. It's very simple. Prices above you buy, prices below you sell. When price is above the average, this is your green light. You can buy as much as you want. You can dollar cost average in. You can start a position. It's up to you. But when price is below, that's a time of uncertainty. That's a time of volatility. We don't want to participate because the trend of the market is down. We want to wait until things shake themselves out, let the dust settle, and then we'll participate once things get going back in the right direction. Hey, pro tip, turn off the news. You don't need that shit. It's not going to help you. If you're trying to learn how to invest or trade the stock market, the news is just a giant distraction. I don't know how the market's going to react to the news. Nobody really knows how the market's going to react to the news. So why worry about it? The market will price it in. Turn off the news, let the market have its reaction, and then you just respond to what the market does. It'll save you a lot of stress and save you a lot of money. Trust me. So the market is designed to go up. That's for sure. But sometimes things happen. There are uncertain events, there are unexpected outcomes like elections or wars. And during times like these, the market can decide that it's going to go sideways or maybe go down until these periods of uncertainty or fear resolve themselves and go away. During those times, we don't want to participate. And this is exactly what smart money, professional investors, institutions, and hedge funds, is exactly what they do. When the trend of the market changes, they sell their positions, go to cash, and wait for the market to shake itself out. And if you want to beat the market, you've got to think like the market. All right, so that's all great. How does this strategy exactly work? Well, you look on the chart here, we're looking at the S&P 500, and we're going to look at the dot-com crash first. You can see here, I have a point marked. It's 29 September of 2000. And right here, price closes below the 200-day moving average. There are a couple of other times leading in that it does. It gets back above. But here at the end of September, it closes below, and the strategy really kicks in. Price moves down. This is when you would have sold, somewhere around that 1436 level. And then we can see over the next year and a half, price continues to move down. It bounces and keeps moving down. It bounces and keeps making lower lows, even though it bounces. And then finally, on 14 April 2003, price gets back above the average. One of our buy signals would have kicked in, and we would have gotten back involved in the market. Now, if you were a buy and hold investor, you would have saw the market fall from 1436 at its lowest point to below 800. But let's use 884 as a benchmark for the 200-day strategy. Buy and hold investors would have seen their portfolios drop over 40%, whereas using this strategy, you would have experienced about an 8 or 9% drawdown in your portfolio before going to cash. But then here's the beauty of the strategy. You would have gotten back in the market in April of 2003 and rode the wave back up. Then in February of 2007, we can see the price got back to our break-even point, where the strategy originally got you out of the market. At this point, it's been 6.5 years, and buy and hold investors are sitting at break-even, whereas those using the 200-day strategy would have seen their portfolios up over 30%. So those are your choices here. See a drawdown of 40% and be underwater for 6.5 years, or take a small haircut, go to cash, and then make 30% on the way up. That's how you get ahead of the market. Let's look at another quick example. This is the great financial crisis. So we're looking at 2007 here, and we can see that the strategy would have kicked in December of 2007, right around the 1486 number, and triggered a sell. This is when you would have went to cash. Buy and hold investors, they're just suffering here, watching their retirement slip away as their portfolio bleeds out. Ultimately, the market again fell below 700. So that's a drawdown of almost 50%. But when the signal to buy back in for the 200-day strategy triggered at around that 884 level, their portfolios would again been down about 40%. And this is where you would have gotten back involved. Over the last 25 years, the 200-day strategy dominated buy and hold investors by returning 400% versus 300% from the S&P 500 for buy and hold. This is what it looks like to stop taking what the financial system gives you and start taking what you deserve, the ability to choose your own path to financial freedom. Avoiding these market crashes and making money while everyone else is just getting back to break even is how you take control of your financial future and how you retire on your own terms. I put a link in the description to a 25-year backtest of the 200-day strategy that covers all the major market events of this century. You can see how the strategy returned that 400% number versus 315% from the S&P 500. Check the link in the description below and see how this single rule-based strategy can help you be ready for the next market crash. Check the link in the description below. So a question I get a lot is, but if I sell, won't I miss the rally on the way back up? Shouldn't I just buy the dip? Well, here's the thing with that strategy. You don't need to worry about any of that. Like I said, turn off the news. Don't worry about that. Let the market do its thing. The market's going to do what it's going to do. And when it sends you the signal that the trend is going back up, that's when you get back in the game and you start participating. You don't have to worry about deciding what to do. You just let the signal tell you. There are going to be times where price moves around. It's above and below the average, but you still don't have to decide what to do. If price is above, you buy. If price is below, you sell. And the market will figure itself out and will pick a direction. And the 200-day strategy will make sure that you're involved if you need to be and in cash if you should be. It'll keep you protected and it'll keep you participating. All you have to do is learn how to control your emotions and trust the strategy. Today, you've seen why risk management is so important and learned how it can keep you on track to your financial future. It keeps you safe when the market starts going down, and it gets you involved when the trend changes and starts going back up. You learned how this simple strategy can put you in control of the future that you want. Check the link in the description below so you can get that 25-year backtest and see exactly why, when people ask how I was able to retire in my mid-30s, why I recommend they get started with the 200-day strategy. It's the perfect risk management tool to keep you on track for the future that you want. So this is a great first step, and I hope you've seen what's possible using the 200-day moving average strategy. I hope it shows you that it is possible to beat the market. It is possible to take control of your financial future. It helped me. And over the last 10 years, it's helped dozens of friends and family members who have come to me looking for the same kind of advice that Jay was looking for. How do I protect myself during a market crash? How do I retire early? All of these questions can be answered. You can beat the market. You can retire early. I promise you it can be done. I've seen it time and time again. And the 200-day strategy is a perfect way to get started. And in this next video, I'm going to show you how Wall Street makes money while everybody else freaks out and panics. I'm going to show you exactly how, while the market's crashing, they get richer. I'm going to show you how to change sides during the wealth transfer forever.